Welcome back to my channel. Balance sheets matter. In this video, we're going to be looking at Meta platforms and do a stock analysis on Meta. But before we do that, make sure to subscribe to my channel. Balance sheets matter. If you like looking at individual stocks and you want to get good ideas of potential stocks to buy or value traps to avoid, make sure to subscribe to the channel and like the video. That's exactly what we do here. And we do that by diving into financials, seeing what's basically changing in the stock, what's going good, what's going bad, and use that information to determine a valuation for the stock or where they could be going basically forward in the future to find out if it actually is a good value or a value trap. And with that, let's get into Meta platforms. And the one thing we're really going to be focusing on Meta and talking a lot about is their very high increased CapEx spend going forward. Because if you've heard the news, basically, Meta is planning in 2026 to spend a projected 115 to $135 billion in 2026. And then even in 2027, they're even talking about spending $142 billion. And beyond that, we don't exactly know. It could be more, it could be less, it could be in line. And one thing to keep in mind for Meta, which I do want everyone want to keep in mind is, well, they're spending all this money on AI. All this AI money is really just going to go towards trying to enhance their ads, because 99% of their money and their business does come from ads. Well, they have tried to diversify a little bit away from that. That is still just the entire business at the end of the day. So with that now, let's start basically diving into financials of Meta. So the first thing is they are trading at a 28.47 PE, and they do have a forward PE of 22.48. And this implies that the analysts are expecting them to have growing EPS going forward in the future. So let's dive into the financials here. And you can see that Meta has grown at basically a very rapid rate in the past, 27% over the last 10 years for revenue, and EPS at 22.7. Although from the analyst projections here, as you can see from the green line, their revenue trend is expected to slow down, which comes to approximately a little bit under 15% forward going per year, which that's still a very good growth rate. And when you get really big, it's really, really hard to basically keep going at, that high of a growth trend. And we can basically see that from the revenue. They have exploded, from 2024 to 2025, 164 billion to over $200 billion, which is huge. But the one thing I do want you to basically point out, and I do want you to notice, is that, for example, in 2021 to 2022, and this is, years ending in 2021, so during 2022, when basically the inflation hit, there wasn't even a recession, but it did kind of hit the economy a little bit. And Meta, they actually had a contraction in their revenue. So that is something to basically keep in mind about what we were saying of where Meta makes all their money, being basically from advertising, and that they are a more economically sensitive company to this type of, if there was a recession, you could actually expect it to go down a lot further. And if we compare this to Alphabet, which I think about 75% of their revenue is basically ad related. You can see 2021, 2022, they actually still managed to increase their revenue. So this does show that there is a higher sensitivity towards a softer economy with Meta, maybe compared to other advertising platforms like Google. So, but we do see that their gross margins are very strong. And one thing I always like to also point out is their operating margins, which are also still very, very strong. Well, there is a little bit of fluctuation. If we look at the longer trend, I still think they're maintaining basically just fine. So overall, the company's not losing its competitive moat basically, but as we identified, can be economically sensitive. The next thing is we're going to look at the interest expense, which is basically your interest income or your net interest expense, your interest income minus your interest expense. And this is one thing that has been changing in Meta a lot. Well, they have had really high interest income and it still is positive. The net interest income has been going down. And well, why is this? Well, one thing is even though the Fed funds rates are still really high, and that's why they're earning, so much interest income, and they could potentially basically go down in the future, they are starting to spend more money on all this CapEx spend, which is reducing their, hordes of basically cash sitting on their balance sheet. And as they're doing all this CapEx spend, they were also taking out more debt. And where they had virtually no interest expense before, this is actually getting quite significant. So, well, before, Meta was a company with a very strong balance sheet and no debt. This is something that is significantly changing in the stock. And like I was saying, when we look at stocks, we have to see, what's changing and how it can affect their value going forward in the future. And the one thing with big tech companies, these were obvious CapEx like companies in the past, very strong balance sheets and no debt. And this is one thing that now is pivotally changing with Meta. So just, keep that in mind going forward. One thing, just based on projections, which we're going to be doing shortly, is while the tax rate has fluctuated a lot based on the big beautiful bill or whatever, they're saying that next year they're going to have 16% tax rates because they do have international exposure. And anyway, some little projections I'm going to be doing, I'm going to be using a 16% tax rate going on in the future. At the end of the day, right now, that's left them with $60 billion of net income. That is a 30% margin. You can see it has been higher in the past. It has been lower in the past, 2022, when they did have that revenue contraction that, did actually lower it quite a bit. But, compared to some previous years where it was 39, 40 almost in 2017, 2018, it basically has contracted, a little bit over time. And EPS has, effectively been going up quite, strong as well. And that's largely also because the shares outstanding has been going down. Although I do want you to notice that maybe compared to some previous years, like 2021 to 2022, they actually bought back 150 million shares. Then there was 80 million shares the next year. This is only 10 million shares. And how much is this year? About 40 million shares or so. So over the long trend, actually since 2010, 15 years here, Meta kind of actually has increased their share count a little bit. And this is because as a tech company that they do have to, get the top talent out there. And there's a lot of stock-based compensation, as we're going to be showing on the cash flow statement. And while they have been doing a lot of share buybacks in the last 5-10 years, as you can see in December 2017 here, they had almost 3 billion shares. They have reduced that quite significantly. And you always do hear in the news, Meta's buying back, however many tens of billions of shares. All of this is just offsetting basically what they are issuing. And I think the expectations for their shares outstanding going forward in the future is something that we do need to take into consideration, considering this high CapEx spend, as I will get into in the future. And as I alluded to earlier, basically their cash and cash equivalents is starting to go down a little bit. And this is because they are spending all this money on CapEx. So I would basically not expect as a strong balance sheet basically going on in the future. Well, actually, cash and marketable securities still is, actually pretty high. But anyways, I would probably expecting them to spend this cash if they are basically expecting to spend, over $120 billion per year in the next 2 years. The major thing to kind of realize on their balance sheet here is the long-term debt, because this is something that in the past, they basically had no long-term debt. And since they started doing this AI build-out, they have started taking long-term debt, and that's where the interest expense is coming from. And this is growing, and this will probably grow in the future as well. And now just keep in mind when they did start, really doing the higher, taking out the debt and doing the AI spend was kind of, ending in 2022 and the few years going forward. Because the one thing I also do want to point out is, well, their total equity is very, actually grown quite a bit in the few years. This is because of all the assets on their balance sheet, a lot which is because of their recent big growth in CapEx spend. And when we're talking about, they're going to be spending 120 billion, this 2026, which is this year, and, even 140 billion the following year, they actually, have been over the last few years having quite a more aggressive CapEx spend. And you can see in 2022 here, they spent $31 billion. 2023 was marginally less at 27, increased to 37, a big increase to almost 70 billion. And now we're actually talking about spending, 130, 135 billion, then 140 billion. So you can kind of see how this rapid spending in basically CapEx is reflecting basically of what we're seeing on the equity on the balance sheet, because they are spending at a lot higher rate than they are currently depreciated. This isn't accounting fraud or anything. There's, basically schedules you're supposed to depreciate your assets at. And from what I was seeing, the estimates are is a lot of this current CapEx spend they're doing is basically for the AI and will be on approximately a 5-year depreciation schedule. And The one thing to really kind of notice from this, of even though in 2025 here it was only $70 billion, only $70 billion. If you look at their net income from continuing operations here, that's $60 billion. So actually, how much more did they spend than what they depreciated? And if you basically take your purchase of plant, property, equipment, you minus your cash flow from depreciation, you're going to find it's $50 billion. So they spent 5/6 of all their basically net income effectively in CapEx investment. And if now this number is planning to effectively double the next year, they do not actually have enough net income from continuing operations to actually fund that. So that is basically leaning towards they are going to be having to take out debt, or well, maybe not issue shares, but not rebuy shares to basically offset the stock-based compensation. Because as we're talking about stock-based compensation, you can see one reason why their cash flow is so high is they do have basically $20 billion of cash flow from stock-based compensation, which that means they are expensing this on their income statement, but they're not actually having to pay out cash. Instead, they're paying out stock instead. And typically what Meta has done to basically keep that share count slowly going down as we go down on the cash flow statement here is they do repurchase a lot of stock. As you can see in the last year, it was $26 billion. But this is actually down from, $30 billion the year before, and even, $44 billion in 2021. And I think this is a trend that is going to change, quite a bit, because, just starting to do a little bit of napkin math here, they made $60 billion of net income from operations, last year. And how are they going to, offset that when they spend $120 billion in CapEx? Well, they're going to either basically have to, stop repurchasing stock, and then the share count is going to go up, or they're going to have to take on more debt. Both of those, which are not going to fundamentally improve the balance sheet in Meta and may actually affect their valuation going forward in the future. So the next thing to basically look at here is I just want to go back to one last little thing here is also one of the reasons, for example, the cash flow for operation was so high is from the big beautiful bill. They do have some deferred tax, but remember, well, they get the cash flow from this. Deferred tax does eventually need to be paid in the future. That's why they call it deferred. So the next thing I'm going to do here is I'm going to bring up a little rough, basically, CapEx projection here. So you can get some ideas of basically what the numbers we've looked at here, this could be meaning for their EPS growth going forward. So this is basically the revenue. And I took all of these numbers, except the last two, right from the analyst estimates, the average analyst estimates. We go over the interactive chart here, and we bring up basically revenue with estimate. These are where those numbers came from. And this year ends up being, 2029 ended up being like 13% growth, and then the following year was 12% growth. So what did I project forward after that? Well, I projected 11% revenue percent growth basically per year for 2020, 2031, and 2032. And then I didn't take the highest in. I took kind of like the middle numbers for 2026 and 2027, basically CapEx. And then going forward, I just kept it at 135. We don't really know what they're going to do. If there's stuff changes with AI, they may could slash AI spend significantly, which if they did do that, they would kind of almost be admitting that a lot of this money was a waste and would not be good. If they keep it the same, well, this would be going forward. And if they increase it, well, it would actually put more pressure on it. And this depreciation schedule here, this is basically based on what actually has occurred. And then because a lot of this AI spend they're talking about is on a 5-year schedule, you can see from the formulation here, this is really simple, like basically napkin math of doing this to give a rough estimate. Keep that rough, but it is going to still give you some good insights here. Basically just taking the last 5 years and dividing it by 5. And this kind of projects what the depreciation could be going forward in the future. And the two numbers we have here are, what percentage is the depreciation and what percentage is the CapEx of their total revenue. So you can see kind of before, 2020, 2021, well, depreciation, is only like 7-8%. Even the last few years, we're not really seeing it catch up. It's only 9. It's been under 10% the whole time. And the CapEx spend from 2021 and 2020 is under 20%. And this is historically, I think, kind of more in line where they did have a lot lower of this CapEx spend. But what we can see, it's been creeping up in the last few years. Okay, mid-20s, not too bad. 2025, which was our last year, 35. But based on the projections going forward, we're talking 50% CapEx spends compared to the revenue. So whatever they're making in revenue, not profit, they're planning on spending 50% of that on capital expenditures. And the only reason these numbers are potentially going down in the future, because I'm not expecting them to actually increase their CapEx in the future, because I think at some point they're going to build a lot of the AI and they won't have to keep going. But keep in mind, these could increase basically in the future. So the next thing is our EBITDA. And as I went over, because they are taking more debt, well, they do have a little bit of positive interest expense right now. Well, that's probably going to neutralize over time. So I'm just not going to factor that in. It's a very minor number anyways. And based on projections, they were talking a 16% tax rate. So I've effectively applied this 16% tax rate and came up with my own EPS projections based on this little napkin math schedule here. And you can see basically what happens in 2026. There is a nice bump in EPS growth. And if we actually go to the Groove Focus here and we bring up the EPS.NRI with estimate, the next year, yeah, $29, which is, pretty much in line with exactly what I have. But then this is where things start to diverge a little bit, because they do not, at least these estimates here, I do not know if they are really factoring in this total CapEx spend, or if they're expecting that somehow the margins and the margins are somehow going to rocket even higher, which doesn't make very much sense because they have the revenue growth projected already. So anyways, regardless of that, using my method here, as then you can see in 2027, EPS growth basically near flat. 2028, again, we're getting very low growth. These are the actual EPS growth numbers going in the future. So what this sudden increase in basically CapEx spend does is it creates this multi-year halt on their EPS growth. And I think this is something that the market is basically going to re-rate and get concerned about, and potentially get very concerned about if there were be a recession to hit, or even not a recession, but just a little bit worse economic times like 2022, where their actually revenue did go down. And you notice here, I'm not taking any numbers where revenue is expected to go down. This is the increasing numbers. So if you were to actually expect revenue to go down one of these years, these EPS numbers would actually go down, and that would not be looking very good for the stock. And one also thing that does heavily apply to the valuation, as I'm underlying here, is the net margins at the end of the day. And in the past, they have had very strong net margins. And what is going to happen basically when they start actually having to depreciate this CapEx spend? Well, that is going to push their net margins down. And what I'm projecting here, it is going to slowly grind them down to 20%. So this is back up the number math, but just use this as like a general idea of what the effect of this CapEx spend can have basically going on the future. And analysts in the market are very short-sighted. Like, what did we see when there was a little contraction in 2022, when the revenue is flat? Well, they sold the stock down to $80, a 2 price to sales ratio, and an 8 PE. And potentially what we have here, even if there is not a recession, we are going to be seeing net margins contract, which typically when that happens, that can cause a re-rating for the price of the stock. And the same thing for the EPS growth. When the EPS growth isn't growing at 20% per year anymore, and we start seeing flat revenue EPS growth, or the other potential is if the share count were to increase because they're not rebuying back the shares because of the CapEx spend, this actually could be going down. So I think this CapEx could fundamentally, at least over the next few years, really potentially change the valuation of Meta. And if we go into the chart here, I do have my long-term growth trend channel, and if I'll just take the thing here just because I didn't pre-draw it, and this is at a trend. We just need 365 days. It's a 20% basically trend of growth, which actually probably fairly accurate of what they have been. And if they're going to be able to do that, that's kind of questionable in the future because they are expecting to slow down. But I think actually after this CapEx cycle finishes, which is actually years down the road, and with the mid-teens, 10 to 15% revenue growth, and then if they're actually able to buy back some shares, they could continue on this trend. So it is very possible this trend continues in the future. But you can see what happened before. is we were at $380, and because 1 year of basically down revenue growth and basically called the higher CapEx spends for Mark Zuckerberg's Metaverse, it went down to $80 and a much lower valuation. So if we take my previous numbers here, I'll just pop those up quickly again. We're talking in the ballpark of $30 EPS. That could be what we're seeing for the next few years from Meta. And down here, they traded for less than a 10p ratio. So if you do kind of think that the market may re-rate Meta because the EPS growth actually does not increase at this trend, and instead, actually once it hits here because of the CapEx, ends up going sideways, that is a very high probability that Meta gets re-rated down to a lower valuation. And that could potentially be a 10 again, which would bring it around to about a $300 price point. And that's why on this chart here, I have, 321 marked. Why is that? Well, you have your previous high here. That's actually a good, technical point. You have your price volume profile here. And, there's this actual little previous consolidation as well. So from a technical level, I could see just in a normal environment, unless, Meta basically has a big boom and is able to actually really accelerate their EPS to overcome this CapEx, basically, it could very easily, come back around into this $300 range. And if there were to be potentially a bad economic time and revenue were actually, heaven forbid, just plateau or decline, potentially they actually could go a lot lower, and you could see as low as potentially $200. And you bring up the price volume profile here, and again, that's where things start happening. And people think, well, that's crazy. That's going to be like a huge overreaction. That's never going to happen. It's like, well, what happened basically back here? And when the company is basically fundamentally changing, let's just go back, and I just want to bring up the 30-year financials here, and let's just look at this 2022 here. Okay, what happened in 22? Well, the net margin went down to 20%. What are we talking about projecting potentially net margins could go down to because of the CapEx cycle? Well, we're talking basically 20%. At this point, they were still buying back shares. We're talking that Meta's share count actually may be increasing short term in the future. And then what's happening here? Oh, well, they barely have any interest expense. Well, if they're going to afford this 125 and $140 billion year after year here, they're not making the money to be able to do that. That's going to have to come from somewhere. And that can mean the share count going up or the interest expense going up. So I think even comparison to 2022, a lot of these fundamentals actually are fundamentally getting worse for Meta. And again, in 2022, we look at what was their long-term debt. Well, only start taking on a little bit. And a few years in the future, this could be $50–100 billion, higher for them to actually fund this CapEx spend. And if you get any uncertainty, and you have this less stable position, I just find it very easy that Meta could get re-rated down to that single-digit PE potentially again, as crazy as it seems. So anyways, that kind of gives you my thoughts on Meta and my stock analysis and the potential risks. It's like, who knows exactly what's going to be going forward. I personally, I don't know, I sold the stock somewhere around here, a little bit early. No, I never sell exactly the the tops there what it is. And a lot of the thing is I do look at these channels and I do look at the upside and the downside. And right now I just see the upside is potentially very risky for Meta, and there is a lot of potential headwinds, especially from this CapEx spend, that once it starts getting priced in, it could potentially create a lot of downside. But from a longer term perspective, getting into Meta at 300 or under, I think would be very attractive. As I did say in their actual income statement here, the fundamentals of the company of the operating margin and the gross margin, those are still actually looking pretty good. So they're not losing competitive moat. You kind of know Meta kind of has almost a little monopoly in some of their social media things of Facebook, Instagram, WhatsApp or whatever. It's a very strong moat in that, and they should be improving their advertising tools at the same time. So long term, Meta, a lot of potential upside, but from this current CapEx spend, could have some downside we see in the next few years in the future. So anyways, I hope that gave you a few insights into Meta. Right now I'm not shorting it, I'm not long it, I'm just basically waiting that if it comes down and starts getting into these levels, I'm gonna re-examine everything that's going on, and probably somewhere around 200 to 320 is where I would potentially take a big position and go long Meta again. So anyways, I hope you like that stock analysis. Make sure to subscribe to the channel and like the video.